There is a piece of advice you'll hear in almost every European investing video, including good ones. Always pick the accumulating ETF, it's better for tax. Most of the time, that advice is right. But here's what almost nobody tells you. In some European countries, that's exact advice that does nothing for you, and in a couple of them, it can quietly even cost you. The reason comes down to one word that changes everything depending on where you live. That word is tax. Today, I'm going to show you when accumulating really is the smarter choice, the handful of countries where the usual advice falls apart, and, most importantly, how to find the right answer for your own country in about 10 minutes without paying anyone. Quick context if you are new here. I am Ivan. I spent 23 years in finance, most of it as a board member of a development bank in Eastern Europe, where I sat on the credit board and personally apprised over 10,000 financing decisions, from a family buying their first home to large institutional projects. And here is the habit that job drills into you. You never accept a general rule without question. You check whether it actually applies to the case in front of you. That is exactly the discipline this topic needs. My goal here is simple: to explain this the way I'd explain it to a friend across the table. No jargon, no hype. If you saw the last video, you'll know this, so I'll keep it quick. When the companies inside your ETF pay dividends, the fund does one of the two things with that money. A distributing ETF pays it out to your account on a set schedule. Depending on the fund, that might be monthly, quarterly, twice a year, or once a year. On accumulating ETF, keeps it and reinvests it inside the fund automatically. Same underlying companies, same performance, the only difference is what happens to the dividend. That's it. The interesting part isn't the mechanics, it's what each one does to your tax bill. Here is why the peak accumulating advice exists and why it's usually correct. In most European countries, when a distributing ETF pays you a dividend, you owe tax on it that year. So, if the fund pays you 100 euros, for example, you might keep, say, 80 after tax. Now, if your plan is to keep building wealth, you take that 80 euros and reinvest it. But notice you've only got 80 left to put back to work and not the full 100. With an accumulating ETF in a lot of European countries, the dividend is reinvested inside the fund automatically, and you don't pay the tax until you eventually sell. So, the full 100 keeps compounding for years. Over a couple of decades, that gap, paying tax now versus paying it much later, genuinely adds up. Now, one important caveat, so this is fair. This only matters if you were going to reinvest in the first place. Plenty of people deliberately choose distributing ETFs because they want that cash landing in their account to actually spend. And that's a perfectly good reason, not a mistake. The tax deferral advantage of accumulating is an advantage for the saver who's reinvesting everything. If you want income to live on, it simply does not apply to you. So, as a default, for someone in the wealth building phase, accumulating is a reasonable starting point in many countries. But many is not all. And even wealth building isn't everyone. This is where the general rule that accumulating ETFs are always beneficial for everyone breaks down. Let me give you the real picture, because it's a spectrum, not a yes or no. Take Austria. There, an accumulating fund's gains get taxed every year as they build up. They call it distribution equivalent income. Concretely, you pay the 27.5% Austrian capital gains tax on 60% of those gains every year as they accrue, and only the remaining 40% is deferred until you actually sell. So, you are paying tax out of your own pocket every single year on gains you haven't cashed in, which wipes out most of that famous deferral advantage. Switzerland is different again. There is no capital gains tax for private investors when they sell ETF shares at all, but dividends are taxed as income every year, whether they are reinvested or not. So, for a Swiss investor, accumulating versus distributing makes essentially no tax difference. In both, that advantage that usually makes people reach for accumulating simply does not apply. Then there are in-between cases. Germany, for example. Germany charges a small annual prepayment on accumulating funds, called the Vorabpauschal, which was brought in specifically to take away most of that deferral advantage. It's only a partial, notional amount each year, not full taxation, and equity funds get a partial exemption on top. So accumulating is still perfectly common in Germany, just not the big tax swing people often assume it is. Ireland has its own twist, called deemed disposal. Even if you never sell, every 8 years you are treated as if you had. You pay tax on the gain so far and the clock resets. The key point for us is that this hits accumulating and distributing exactly the same. So, in Ireland, there is no tax advantage to accumulating at all. So the choice really comes down to whether you'd like the cash landing in your account or not. Notice what just happened. The same single piece of advice, pick accumulating for tax, is right in some countries, pointless in others, and beside the point in a few more. That's the thing most people get wrong. They treat a local rule as a universal law. The reason is simple once you see it. Some tax authorities look at an accumulating fund and essentially say, "We don't care that you didn't take the money out. The fund earned income on your behalf this year, so we are taxing it now." Other countries say, "Fine, we'll wait until you actually sell." That single difference in philosophy is what decides whether accumulating helps you or not. It has nothing to do with the ETF itself. The very same fund can be tax smart in one country and tax neutral one border away. Tax is the big one, but two smaller things matter too. Convenience, for example, if you are a long-term investor, accumulating is simply less work. The fund reinvests for you, so you are not manually reinvesting each payout yourself and paying a fee every time you do it. And life stage. If you are still building wealth, reinvesting everything usually makes sense. If you are retired and you actually want regular income landing in your account, a distributing fund can be the more comfortable choice, even where the tax is identical. There is no universally correct answer. There is only the right answer for your country, your stage, and your temperament. So, let me be straight with you about something. There is no honest way for me or anyone to give you the exact current tax answer for all of Europe in one video. The rules differ in every country and they change. Anyone who claims to have all of it memorized is selling something. What I can do is show you how to find your own answer properly in about 10 minutes. Start with a free website called Worldwide Tax Summaries, run by PwC. That's PricewaterhouseCoopers, one of the world's biggest accounting firms. You'll find it online at taxsummaries.pwc.com. Look up your country, find how it taxes capital gains and dividends, and check whether accumulating funds get taxed annually or only at sale. If your situation is even slightly unusual, you've moved countries, you have ties in two places, that's the moment to spend an hour with a local tax advisor. That hour is some of the best money an investor can spend. And I'll put the link to that PwC website plus the steps to look up your own country in the description below. So, to pull it together. 1. In many countries, accumulating ETFs let you defer tax and compound more, which is why they are a sensible default while you are building wealth. 2. But that advantage is not universal. In places like Austria and Switzerland, it effectively disappears, and elsewhere it can be neutral. 3. The real skill isn't memorizing a rule, it's checking whether the rule applies to you. Look up your own country before you choose. That one habit will serve you for every investing decision you ever make. And the necessary note, because this matters, I am not a tax advisor. Tax rules vary and change, and nothing here is a personal advice. Use it to ask better questions and to check your own situation and not as instructions. If this was useful, do me a quick favor and hit the like button. It's one of the main signals YouTube uses to show this to more European investors, so it generally helps. Thank you. Subscribe if you'd like to see one of these videos every week. And if you are just getting started with ETFs in Europe, watch my video on why European ETF investing works differently. It's the foundation this one builds on. and it's in the playlist link below. Drop a comment with the country you invest from, and I'll keep these examples coming. I'm Ivan. This is the Banker's Notes.